This is Africa Weekly Record. The week ending 27 March 2026 did not produce one single dominant headline. Instead, it produced something more important. A pattern. Across the continent, the real story this week is not only what happened. It is where pressure is building. Borrowing needs remain high. Trade costs are rising through shipping, fuel, and freight. Policy space is narrowing in visible ways. And yet, alongside that pressure, reform and infrastructure signals are still emerging. So this week's record is not a recap built around noise. It is a structural briefing. Debt pressure, trade cost transmission, institutional strain, and the signals that still matter beneath the headline. This is Africa Weekly Record. Several African governments are expected to stay active in debt markets again this year. But the issue is not borrowing alone. In Senegal, tighter fiscal conditions have made financing more politically sensitive. In Gabon, IMF pressure and liquidity strain are narrowing room to maneuver. In the Republic of the Congo, oil dependence still shapes debt risk and refinancing pressure. These are different cases, but the pattern is the same. When borrowing pressure rises, budgets tighten, debt service bites harder, and policy space narrows. The real story is not the debt headline. It is the shrinking room to choose. Global shock does not enter African economies only through speeches or headlines. It often arrives first through shipping, fuel, insurance, freight, and delays. With the current conflict in the Middle East, African nations have these pertinent issues. When war risk insurance rises, when shipping is rerouted, and when freight becomes more expensive, those costs do not stay confined to ports and vessels. They move into import bills, business costs, inflation pressure, and eventually into the policy choices governments and central banks have to make. That is why the most important Africa angle this week is not distant conflict itself. It is transmission, how a disruption elsewhere becomes a pressure point here. For fuel importing states especially, higher freight and energy costs can narrow room for rate cuts, strain household purchasing power, and make already difficult budget decisions even harder. The system effect matters more than the spectacle, because the quiet cost is often the one that lasts. This week, Senegal, Congo, and Gabon offered three different versions of the same underlying story. In Senegal, debt service and financing pressure remain closely watched, even where payment discipline is preserved. In Congo, IMF concern points to worsening fiscal strain and wider regional fragility. In Gabon, the turnback toward IMF support and reform discussion shows how quickly financing room can narrow, even in a resource-rich setting. These are not identical cases, but together they show what tighter policy space looks like in practice. More external scrutiny, more pressure for credibility, more importance placed on institutional anchors. The deeper lesson is that when margins tighten, countries do not simply face debt problems. They face narrower choices. Not every meaningful signal this week pointed in the direction of strain. Some pointed toward institutional response. South Africa's planned fiscal anchor matters because it signals an effort to strengthen budget discipline through a clearer medium-term framework. It is not yet an enacted reform, and it should not be presented that way. But it is still an important signal about how one of Africa's largest economies is thinking about credibility and fiscal sustainability. Nigeria's ports finance deal matters for a different reason. It points to infrastructure upgrading, trade facilitation, and the long-term effort to improve logistical capacity in a system where transport inefficiency carries real economic cost. These do not cancel out the pressures elsewhere, but they do provide a necessary counterweight. Constraint on one side, reform and infrastructure on the other. A few shorter signals also deserve attention this week. In Kenya, IMF talks continue, but without a near-term lending agreement yet in place. In Zambia, program timing may stretch beyond the election calendar, which matters because political timing can narrow financing certainty. In Morocco, rates were held steady, reinforcing a message of macro stability as improved agricultural conditions support growth expectations. And in South Africa, inflation returned to target, which matters, because it affects monetary expectations, household pressure, and the room available to policymakers. None of these stories needed the full spotlight today, but each belongs in the weekly record. A few additional signals deserve brief attention, even if they do not sit at the center of today's economic frame. Reuters reporting on Russian, Linked recruitment networks across Africa points to a sovereignty and citizen protection issue that may require closer watching if it expands. South Africa's troop deployment is significant as a domestic security and state capacity signal, though it sits outside this week's main macro story. And Somalia's southwest split remains a serious governance development, especially in the context of federal cohesion and political stability. These are not today's lead stories, but they are not background noise either. They belong on the watch list. This week's strongest lesson is simple. Africa's most important pressures do not always arrive as dramatic events. Sometimes they arrive as tighter margins, higher borrowing needs, more expensive trade routes, more difficult policy choices, and a growing premium on credibility, discipline, and institutional response. That is why the real story this week is not only what moved, it is what narrowed: policy space, financing room, and the cost of delay. As always, this is not a verdict. It is the weekly record. Context before conclusions. See you in the next one.